We want to stick with the topic of the Federal Reserve and the markets with our next guest. We're welcoming into the stream Frances Donald. She's global chief economist and strategist at Manulife Investment Management. And Frances, thank you so much for joining us. And when it comes to the Federal Reserve and where they're at now with policy, you mentioned in a recent note that the Fed is, quote, not in a comfortable position. What do you mean by that?
There's a lot of reasons this Federal Reserve is not going to feel great about the current situation that it's in. Now, on one hand, we have many developed market central banks who are choosing to sacrifice future growth in order to attempt to address current inflation. That's the Bank of England, the Bank of Canada, New Zealand, Australia. And then we have the ECB on the other side, where President Lagarde saying, you know what, we don't want to overreact to this type of inflation, and explicitly stating that the market pricing for hikes was not consistent with her guidance. So now we have the Fed that has to choose between two camps. As they go into 2022, we know growth is going to slow pretty quickly, and we know that inflation will mechanically start to decline. And yet inflation right now does seem to be a problem. This puts the Fed between a rock and a hard place. And this is exactly what we're seeing in the flattening of the curves, the market telling us that if central banks choose to fight inflation, which in my opinion, they can't really fight this type of inflation, they will sacrifice future growth. They will put us into a more difficult growth environment. That's the flattening of the curve. And that flattening of the curve, I guarantee you, is keeping the Fed up at night.
Frances, I made a frowny face on my notepad on something you wrote here. I want to ask you about it. You see a second half 2022 marked slowdown in growth. What would drive that, and what type of growth slowdown are you looking for?
So the first half of 2022 is where we see that growth slowdown. It doesn't take a genius to see that every model for PMIs, every strategist is going to see the exact same thing. PMIs are going to start to decline. We're going to see a very big move in fiscal. Fiscal has gone from being a massive tailwind for the U.S. economy. It's going to fall off sharply. Actually, the biggest year-over-year change in fiscal stimulus since the 1940s. We're going to feel the lagged effects of China roll through in the first half of 2022. And that U.S. consumer, well, yes, they have pent-up savings, but those pent-up savings are with the rich and the 55 plus, not those with high propensities to consume. Meanwhile, supply chain disruptions are limiting the business sector's ability to rebuild and restock inventories. Now, when we get to the second half of 2022, those supply chain disruptions will really start to come off more quickly, at least based on what we know now. And you can see that CapEx cycle really leading the economy into a more sustained recovery. But we got a pothole to get through. And this is why the Fed has to balance the fact that, yes, we're in a recovery. We're not in emergency situations anymore. We could use more normal rates, but is now the right time for it? The bond market is telling you no.
And Frances, speaking of those supply chain concerns and how you mentioned that they may start to dissipate next year, are the disruptions that are taking place now pushing demand into the future? And should we expect a rebound on that front? Or is some of this demand actually being permanently destroyed?
That's a great question, and something that I think a lot about. I think it's probably a mix of both. But when we look at the data, what we need to be monitoring is real versus nominal spending. So in the past, maybe you spent $100, you got 10 items. Now you're spending 120, but maybe getting 8 items. There are some things that will create demand destruction. We know higher energy prices, higher food prices, hard to shift away from those. Those create demand destruction in that you can't purchase other things. We also need to look for wage growth, which again is really segmented. It's really occurring in the low income for Americans, which is great news. They should have it. But a 5% increase on $10 an hour is very different than a 5% increase on $30 an hour for aggregate spending. So all in all, when we put this story together, yes, there are good things happening. It is a little bit middling, but it's challenging to see how we see this really aggressive recovery in the first half of 2022.
Frances, moments ago, we asked Zoom Info's co-founder, Henry Schuck, on when the Great Resignation may end. He says he doesn't see an ending. When do you see an ending?
I think there are markers of this that will continue. We're seeing that the concept of labor in the economy is changing very quickly in economic circles, but it calls into question one of the most important data points in the United States that just doesn't get enough attention, and that's labor force participation rate is still extraordinarily depressed. And until we see that labor supply come back online, it's going to be difficult for this economy to reach escape velocity. So I think, yeah, there are elements of this where labor is going to be asking for different type of work, But there are still, millions of Americans who are sitting on the sideline and saying, I'm not interested in work at all. They have very legitimate reasons for that. When you look at all of the survey data, it's not just government support. So we need to be monitoring just how this is changing and creating chaos for central banks, but also for growth. My sense is that central banks really need to focus on this great resignation. They need to focus on the shortage of labor and allow that to overheat a little bit more. Reheat is maybe the better word. Until then, they won't see a full recovery.
I want to ask a little bit about stock performance recently, because of course we have stocks hovering at record highs, small caps actually posting their best day since August yesterday. And we had a guest on yesterday talking about the fact that heightened capital expenditures and a rebound on that front for companies could also benefit small caps here. So I'm wondering, when you think about strategy and where investors could still be putting money to work, do you see small caps and other cyclicals as still being an area of potential further appreciation?
Well, absolutely. But here's the key. Currently, this month, right now, what we have is a curve flattener and central banks that are looking a touch too hawkish, which suggests a shorter cycle. The moment to put cyclicals back on is when you see the whites of the eyes of people like Powell and central banks start to make their pivot. That's when you get the re-steepening. That's when you see the cycle extended. That's when you can start to see that US dollar weaken and this recovery can catch on. So I talk a lot about a policy pivot, but not knowing whether it comes before or after a policy mistake. Once we see that dovish shift from Powell, once we see it from other central banks, then yes, I'm very happy to put those re-steepeners, those cyclical trades back on. I'll be very loud about wanting to do that at that time.